Welcome, everyone. I'm Angelo Robles, and welcome to At Family Office TV. For my podcast listeners, Angelo Robles podcast on Apple and Spotify. And as always, for my members at SFO Continuity, we highly encourage you being live to participate. And I appreciate all of you at SFO Continuity. Today, we have an other one. I've been on a trend with these since the summer. I'm calling this one Family Office Showdown. Private company direct investing versus private equity funds. It's Robles, that is me, representing being a direct investor, and Grenley happens to be our special guest today. That would be Robert Grenley of Visionary Private Equity Group. Before I have a chance to formally welcome Rob to the show, let me give you a little bit of context. So, again, I know in the family office world, which is boring, vanilla, down the middle, and never challenging ideas, you're probably kind of not used to this. So this is effectively a debate. I've done several variations of debate with multiple people since the summer, from politics to geopolitics to investing to family offices. I find them very engaging, and I hope that I learn from them. And I hope you find them not just entertaining, but of value as well. So I have a perception that strong beliefs should be weakly held. Open and honest discourse is good. And in my opinion, in an overly bland community where we're not challenging status quo and ideas, that is not a good thing. We stay static, we don't adapt, and we don't grow. So I'm grateful having hosted several of these since June, I believe. So probably this is like the fourth one. They've been a pleasure. And I've been looking forward to today's, where again, I'm a big advocate of family offices keeping things internal and becoming direct private investors. You could use the word on the cap table. You could use the word controlling. Depending on the type of investment, that may vary. But I'm a big advocate, which I'll get to when I tell you a little bit about the format. And again, our special guest today, Rob, is going to be talking about the perspective of, no, Angelo, you're at least partially wrong, and private equity funds are the way to go. Again, although sometimes they get a little heated, a little interesting, they're meant to spark discussion and learning from everyone who's a participant. On that note, Rob, welcome to the show.
Thank you. Thank you, Angelo. Pleasure to be here. Look forward to our discussion.
My pleasure. And for the audience, in terms of the parameters have changed for some of the debates that I do. Some of them were very rigid. Yes, I do have my time clock and 5 different subjects and 3 minutes each. This one is going to be a little bit rigid, but a little bit more free-flowing. So it's going to begin where we each get 5 minutes to explain our perspective. And yes, that will really be on the clock. When the clock rings, if we're still going, we should really wrap it up in 15 or so seconds. The other party will then have a chance to give their open commentary. And then from there, I think we'll spark a discussion and questions I'll have for Rob, he may have for me. And as always, what makes this better is a live audience, which I do enjoy being interactive, especially my members via the chat feature of the webinar feature at StreamYard. So we do look forward to that. So we're going to begin in about 1 more minute. I think out of a common courtesy, since Rob is a guest on my show, Rob, would you prefer to go first or after me in our open 5-minute commentary?
Oh, thanks, Angelo. No, I'll go after you. It's fine.
Okay, I'm going to have my Superman cup of tea here. Well, that was hot. Okay, here it is. Here we go. I'm going to set my clock, and I get my 5 minutes, which I've been so looking forward to, more so learning from Rob. But here we go. And we begin. I know it's not what a lot of you want to hear. However, in my decades of working with the wealthiest families in the world and traveling to multiple continents, there are some things that just are realities. And that is dynastic families, family empires are commonly built and maintained upon the ownership and, in my opinion, from what I see, control of private companies. It doesn't mean you're always the founder. Look at Elon with Tesla. You could buy a company and simply make it better. But I believe that being passive in all your investments, and again, from what I see, will not create a dynastic family empire. So there's two core reasons for this. The two main drivers are control. Now, I tend to like control. I don't know, the wealthier families and people that I know, they really appear to like control. So control and next generation engagement are, to me, the two biggest drivers. The family, yourself, but your rising generation gets to understand how the world really works. Your hands get dirty. How do you source deals? How do you negotiate? How do you do initial diligence? How do you do follow-up diligence? How do you then finance, if applicable? How do you hire and fire? How do you understand management principles? This is thrown into the wolves that a lot of your rising generation, I don't care what schools they went to, they did not learn the majority of this. This comes from hands-on mentoring and being active personally. So first, I guess, and even from Rob's perspective, we have to ask, are private investments worth it? Meaning I'm getting illiquidity, whether I'm a direct investor or through a fund. I have more control when I'm a direct investor, but it's illiquid. Am I going to get 300 to 500 more basis points above a public market over 10 years to justify or an other benefit relative to diversification? Now, ironically, live today at 4 o'clock, I got a back-to-back. I have a special guest on who used to work at Bridgewater, and we're going to be largely in agreement, but some disagreement. And that basically is, are 15 public company stocks enough? So you could debate, do I really need to get into quote unquote private companies? But I think the markets are inefficient, especially as a direct investor, and the opportunity for you being active and knowing how to do it, how to do a holdco, how to structure the holdco, how to handle net operating losses, all things maybe not in my initial 5 minutes, but we'll get into. The opportunity to use leverage, roll-ups, even working NOLs, like I said, a little bit beyond the core of my 5 minutes now, but all things that are going to be important. I believe that family capital is the best capital buying into a business. It's my kitchen. I don't want to turn it into a restaurant. I don't want to appease others. I don't want to appease LPs. I want to own what I want to own. I don't want to care about any constraints that a private equity fund may have. It's my family. I do what I do. We buy what we buy, and we integrate it into our philosophies together. If I don't need to deploy capital, I don't deploy it. I'm not needing to force money into investments that may be because we have capital and now we have to deploy it. I prefer to want, not necessarily to need to. I also think the 2 and 20 model is somewhat broken. It's expensive. Do the math. If I got 100 million to deploy, that's 2 million in management fees. Now, I admit I'm making my math easy here, but if that doubles 14.4% over 5 years, I'm potentially paying out 4 million on top of that. And I'm not even talking about the nuances of the contract, maybe more so in hedge funds, but private equity, venture capital too, that could secretly, or a little bit discreetly, very nice word there, add to my fees. So you're telling me, as a private investor that I am, that I can't create a holdco, I can't bring on an operator, I can't onboard talent. It's not that hard. I could, and I could motivate that person with a percentage of the opportunity. You want to call it an operator, you want to call it a small team. And yes, smaller family office, you probably actually, quote unquote, do have the money. Now, getting a little bit deep into the weeds in my final minute. So permanent capital, that's an advantage that I have as a direct investor. Tax efficiency, I control the exit, I control the tax arbitrage. Non-callable carry trade, meaning private equity firm GPs can monetize in advance non-callable debt. Buffett is the king at this, owning banks and insurers. I could potentially get a great return on my investment, and I have high cash flow with depreciation. The business gets depreciation, goodwill, future financing interest, advantage to the GP and a direct investor. I don't see that as being an advantage at all to an LP. As you could tell, I did go 30 seconds over. My 5 minutes is up. Rob, I'm going to enjoy a sip or two of my tea while I enjoy your 5.5 minutes. The clock is on. I'll give you an extra 30 seconds on top of it. There you go.
All right. Thank you, Angelo. I'll try and be very concise, but I appreciate what you say, and I think there is a place. I don't view this as a zero-sum game. I come from the private equity world. My first job out of college, I worked on Wall Street, and so I built portfolios. And our feeling is you don't want to put all your eggs in one basket, however fabulous you think that basket is. And that is one of the benefits of private equity, is there is diversity and risk mitigation inherent to private equity. Now, it's not all equal, because you have to think about, if you're considering a fund, you have to think about where is it in its life cycle. Is it a new fund? It doesn't have many portfolio companies in it. It's going to be a long road to value creation and liquidity. Or is it a mature fund? Do they have a track record? There's a series of things that I would submit that you want to evaluate. But I think it is important for an allocation to consider the value of fund investing. And there's some specifics, I'm being broad, but there's also specifics. For example, in the fund that I'm familiar with, there is the opportunity for direct investment once you're a limited partner. So we really, in that regard, you can get a little bit of both worlds. But I would also, again, just sort of stepping back, if I'm helping someone design a generational wealth type of a portfolio, there is certainly, if you choose wisely and you hit a home run on that one company you invested in, you put a lot of effort into it, etc. Great, but not all of them are like that. In fact, most are not like that. And I would also submit that there's a lot of hidden costs in direct investing. Yes, the private equity model, in our case, it's 80-20 and 1.5. And there's also ways that you can structure where limited partners come first, in the sense of gaining all of their liquidity, all of their investment back, and a time value for their investment back before general partners take any position or any carried interest. In our particular fund, we do that. And so it also, fund investing enables you to take advantage of what we call the network effect. And it isn't a magical thing, but it is this access to deal flow. Several of our investors, limited partners, are family offices, and in a couple of cases, we're the only fund that they've invested in. And it's interesting, and there's several reasons why. Because if you are able to have consideration in a mature fund that has a track record that you can get comfortable with, those are data points. I'm a firm believer in third-party validation. Very important. It's great for me to say, oh, this is terrific, or Angelo to say, oh, this is fabulous. But I value what third parties say and how they react. And so as we do consideration for our own fund, we consider a lot of due diligence points. One of the advantages that we have is we have had a lot of experience in this, prior success. And so you want to bring that to bear into your portfolio. Again, you'll be repeating it through the hour, the network effect. But it is utilizing strategic investors, strategic partners, and also motivating the limited partners. Angelo, you commented that it's a passive investment. It can be, but it also can be there can be motivation to be active within it. And what I mean by that is, in cases that I've seen, you can have the right way to say it. There are vehicles, like special purpose vehicles you can create. We have commercial agreements. You can create commercial agreements with portfolio companies. So if an investor, if a limited partner has domain expertise in whatever that portfolio company does, there is opportunity to earn, let's call it, additional mailbox money that is above and beyond the return of the fund that they would get. So we've created the situations where there's layers of value that if people wish to lean in and become more involved, there's a couple of family offices that are absolutely all about that. And then there's several that, we're an allocation within their portfolio and we're expected to perform to a certain level.
Excellent, Rob, and thank you for the commentary and definitely lessons learned. Before I get to a little bit of maybe my follow-up, a question for you. You said it's possible to be an investor as an LP in your fund and also have the opportunity selectively in certain companies to also be a direct investor. Would that be where I would be on the cap table or through an SPV?
Either. It depends on the size, because in some of the instances or some of the opportunities for direct investment, it could be, quite substantial. And so we've done it in our case where if people they're just getting into direct investing. It's almost like training wheels. And we actually encourage it. I've done it in the fund that I'm involved with. I've done it a couple of times myself. And so the answer is it can be direct if it's if it meets the cap table minimum, or it can be through an SPV, depending on if people want to take a smaller bite of the apple and there's a minimum to hit.
And in the investments that the GP is making into private companies, are they almost solely a controlling interest, a minority interest, and or it varies?
In our case, in our fund, it varies. There's some places where we are, let's say, driving the bus. We have a lot of influence. We have a lot of control or shared control, either significant minority ownership or in some cases, majority ownership. And there's other cases where, again, this is about the deal flow point I want to make, is that we are invited into certain opportunities that simply you just, unless you were part of this ecosystem or unless you were given an allocation, that you simply don't have the opportunity to do. If I can take 1 minute, I'd just like to give you an example. There's like 5 of them, but for example, there's a company called Hyperice. If you may not know the name, but I'm sure you would know their product, the massage guns. Okay, so there was a couple of years ago, they were doing a $25 million financing round. It was sold out. There were 6 participants. It was already oversold. And we were extended the opportunity to participate if we wished. We had a very short time for due diligence, which is kind of contrary to us. We were very conservative and kind of methodical with our due diligence. In this case, the 6 investors were 3 entities and 3 individuals. It was Major League Baseball, the NFL, and the NBA were the 3 entities. The 3 individuals were sports figures. Naomi Osaka, who's a pro tennis player, Rory McIlroy, golfer, and in case there's anyone from Kansas City here, the Patty Mahomes. So we became player number 7. And unfortunately, we're not able to show the 1-minute video that I'd love to figure out a way to get a link to your audience at some point. That was from the Summer Olympics. So we flash forwarded a year and a half. We knew that they were developing wearable tech in a relationship with Nike. So that was one of the very interesting things. It was launched at the Summer Olympics. It was successful at the Summer Olympics. And it is very likely that this is going to be an acquisition from our Oregon friends to first half of next year. But that is an example of the access to deal flow and using that network effect that I, wanted to, by example.
And in terms of some of my follow-up to Rob's comments, he noted relative to concentration risk, how you become rich, now we could debate how you maintain wealth, may be two different things. But I'm going to take the approach of concentration can be good. When you look at the 13 Fs of certain hedge fund managers, basically 40 to 60% of their portfolio is commonly in 3 to 5 companies. When you look at some of the most successful people and opportunities to invest in, you tend to do the right work, the diligence, make a concentrated bet, sometimes a little more than that. And there's only so many good deals to go around. So in answering almost your question to a degree, Rob, I do. I actually may want, to a degree, concentration risk. Now, my audience seems to get all mad whenever I mention this. It's meant to be a little tongue-in-cheek, but there's some truth to it. Getting diversified is basically what caused Bill Gates to not be a trillionaire. If he didn't have advice from Warren or a family office and he just held on to Microsoft, even if he still put $100 billion into, of course, philanthropic endeavors, he'd be worth way, way more money. We all know that. It's been out there than he is now by being quote unquote diversified. Oh, but it's less volatile. I'm a family. I have liquidity. I have a long-term time horizon. I could deal with some level of volatility risk in the investments that I make. When it comes to third-party validation, well, another sensitive issue with me, as I do a lot of work in so-called benchmarking and best practices with single-family offices. Other family offices think they do that as well, and to some degree they do, but how do they know what they're benchmarking, who they're getting a referral from, or their level of exchange of best practices is with anyone who's any good? So in other words, I trust my capability, my ability to research, my tight network that I always look to grow, and I keep it very intimate because honestly, 90% of people, even on the surface, that appear successful, their advice is not worth it to me. And it might even be a little bit either discreetly or not, quote unquote, misleading. Now, maybe that's just me. I also look at certain industries, and admittedly, some of them are real estate plays that I've looked at, car washes, ranch land, farmland, but even traditional firms that are more blue collar type industries that I seem to enjoy. Whenever I usually invest in tech, by the way, it usually is much more as a quote unquote minority investor and sometimes through an SPV. But I look at septic firms. I'm very intrigued by that. Fencing companies. Do I really need to build up a massive team for that? No. Now, you could argue, Angelo, you're a smaller, quote unquote, family office, even if you're moving 1, 5, or 10 million. True, but I could extrapolate those numbers up. And I think the industry is heavily motivated and conflicted to somewhat mislead, sometimes lie to you that this is too hard. You need us. You need the professionals. You need Wall Street. And they have hierarchy. They have bureaucracy. All things, if you do a family office and a holdco correctly. And my final comment before I kick it back to Rob, and then we'll go a little back and forth. What could that look like? Creating the holdco, very easy. Purchase the right anchor asset, excellent cash flows. Admittingly, maybe a little easier said than done. Purchase and fold in additional private companies, further maximizing quote unquote cash flows. Maybe lever up, depending on interest rates and a variety of other factors. Purchase yet more companies, maybe in that given sector with operators, again, that have experience, that have a motivating equity perspective to get in. Now, some may have net operating losses, NOL, that could be, I wouldn't quite use the word good, but it's strategic relative to your other profits in the whole company before you turn those around that are the net operating losses. And then high-level tax strategy and arbitrage can be used to offset income. Now, that would require a deeper tax conversation that we do have some conversations in private companies like that upcoming. So, Rob, I'm going to kick it back to you and see what you either have to say about that or other opinions that you had that your 5 minutes wasn't enough time.
Thanks, Angelo. Well, I mean, it sounded like you were building a portfolio there for maybe a private equity group. I wasn't sure if that was.
My own Holdco private equity, of course.
There you go. So, but again, the concept is valid, right? You want to mitigate risk, and it depends upon where you are, where the LP or where the family office is in its life cycle is, and different people have different, let's say, objectives or priorities. Is it preservation of wealth? Is it a generational thing, a multi-generational thing? Is it more aggressive? Do you divide your liquidity, in the classic pyramid thing, where low risk, mid risk, high risk, etc., or is it, again, along various lines? The many ways to skin that cat, but for me, it's about knowing your customer, because it may be, Angelo, very much that some of the people in your audience, they love the idea of, we want to control it, we want to own it, we want hands-on only. That's it, because we trust ourselves, no one else. And so, okay, that's a piece of the bell curve. Fair enough. But I would submit to you that isn't the whole curve, because it makes sense. It's logical. There's many years of financial, let's say, metrics that would back up the fact that diversification mitigates risk. And at the same time, if you are signing on with people to drive your bus, if you will, becoming an LP, we would be the GPs. You want to see about their track record. You want to see who they have done business with, how well they've done it. And so I think, as you would evaluate a single company, so would you evaluate a fund. And in our particular case, there's some compelling things, but others would have probably a similar argument. But bottom line is, I do think that gaining third-party validation or collective opinions from those in the marketplace that have had prior success, that you can co-invest with as in a particular portfolio company, meaning inside of our fund. That's how we look at it. So first thing is, I want to make sure that we are having no holes below the waterline in terms of preservation of capital. Next, we want to create value. And then, of course, third thing, it's about liquidity.
Okay, I mean, some of my comments to that, and theoretically, Rob is correct. The majority of investors and family offices are not necessarily comfortable being more active as direct investors, sometimes even minority interest. It is simply easier and more convenient. Where that gets a little tricky is, because it's easier and more convenient doesn't mean it's better. Again, I'm going to go back to, you're going to have no control for the most part, and you're not engaging the rising generation. And I'm going to go back to, if family continuity and dynastic wealth is important, that at least has to be some level of a 20% foundational anchor in terms of what you do, from what I see and I hear. At the end of the day, nothing, or I'm going to rephrase that, everything else is a poor choice when compared to an exceptional single family office. In particular, one that believes in internal family controls and next generation engagement. Where the problem with that becomes is, how do you define excellent and how many are mediocre? Forget about mathematical statistics of most are going to be in the 50% percentile. The reality is, most really aren't that good. It's not because they're too small. Actually, being small, unless you're really too small, may actually have, or should, less bureaucracy, and you'd be more nimble, and it actually may be an advantage in certain ways. But somehow, a lot of families and their family offices still seem to kind of, for lack of a better word, seem to mess that up. Now, Rob, also, I believe the private equity firm is somewhat diverse and does some things that trend a little bit along venture. So I believe venture is very intriguing. And yeah, back in the days of David Swenson getting 30-40% returns. But for the most part, to me, those days appear to be long gone for a variety of reasons, possibly too much money chasing relatively too few good deals, and extremely large PE and VC that may have advantages in certain ways, but there's also certain sectors, companies that are kind of too small for them that they have to overlook, that maybe even to $1 billion family could be very, very intriguing. So again, it all is going to come down to the perspective, but I'm trying to change the paradigm to have families realize they could probably do more internally than they think. I'm somewhat living proof of that. It doesn't need to be more complicated. When you outsource effectively to usually 2 and 20 in the fund, just really do the math on it. You could, maybe you don't want to manage that internally. Maybe you don't want to hire the operator in teams. And I get it, but then do understand if you consider family continuity and generational wealth and learning with your rising generation, it's not impossible. They're just simply very much behind the 8 ball. It is simply going to be more challenging to them. I will end and give a commentary to Rob. And I've written about this probably 7 years ago, the Sid Bass and Richard Rainwater. So Sid Bass, the iconic Bass family, in the early 70s, plucked a talented young investment banker that at that time no one knew, the 26-year-old Richard Rainwater. And together with a sharing of some economic interest, they obviously went out and did incredible things. Sid Bass and the Bass family did wickedly well, and Rainwater didn't do so bad himself, eventually making it into the Forbes 400 and becoming a billionaire. Now, was that easier back effectively 50 years ago? In some ways, no, but I'm going to broadly go with probably yes, partially due to competition reasons. But the concept of it, at least to me, is still very, very attractive. And for family office executives that want to become that 7 and 8 figure earner, potentially the way to do that is aligning, including with economic interest in investments. There's a variety of ways to do it, including some that are phantom, quote unquote, equity, how to structure golden handcuffs in the family office, an investment company or entity, and or a holdco. Now, I should have Trish Botoff or someone on. We could do a 2-hour discussion about comp. So I don't want to make that too deep in terms of today's dialogue. Maybe one final comment, and then I'll kick it off to you, Rob. Maybe more so on the VC side. I think VC is great for America, entrepreneurial spirit, supporting entrepreneurs. Some of them will make it, and I think that's awesome, and I would love to do that. But I also look at the math, and a lot of VC recently, it's not so good. Why, going back to maybe how I originally kicked off, do I even want to get involved in certain private company sectors when I'm potentially getting a better return in something that's totally liquid and transparent? For instance, could I probably just invest in Meta and maybe Meta and some others? But let's go with Meta and compare that to a VC portfolio, go to sleep for 10 years. I think the math is going to show I'm probably, and who knows what the future may hold, who knows, but I'm probably going to win 90 to 92% of the time. And I know what I own. I'm totally liquid. Enough about me. Rob, it's all yours.
Hard act to follow. It is, I'll address a couple of things you said sort of earlier on in that segment about in our particular case. Again, I want to speak from our experience broadly as well, but from our experience, yeah, there are elements of venture capital in our private equity fund. We are a late stage first fund, so relatively small by PE standards, but we're big enough that several of our largest holdings are in a very positive inflection point. So if you get to that place in private equity where you have had a track record, you have had liquidity, and people are able to come in at the stage where there's this, we call it a hockey stick, there's probably better words now, but where several holdings are really hitting that maturity place. Again, it's about risk mitigation for us for the start, and then it's about proximity to equity, proximity to liquidity. So with the private equity envelope, if you will, within it, we ourselves, again, I can speak only from our experience, is we absolutely encourage LPs to get active. That is, we have a number of them that really are part of that network effect where they have domain expertise in a particular area. They have the ability to have their next generation get involved in whatever is the appropriate thing. We're absolutely an open book with that. We like that because we're all stronger if we include, let's call it enlightened mutual interest. That's what I would say. So this is maybe a little bit of a different spin on what you would classically think of private equity, where it's the moat, the wall, and you're an LP, send us your money, we'll send you returns. We think a lot more interactively, and it's been effective for us in our fund. And we think it builds long-term relationships. That's one of the things that we really, again, lean on that network effect.
Okay, a couple of comments, and part of my comments, I want to bring you into two of the three bullet points or comments and have a little back and forth that we may end up basically agreeing on. But I will make one comment first, and that is relatively in the world of VC, having traveled to Silicon Valley more times than I could count, having interviewed prominent people, having been active in that community, it's a bit of an insider's game. The things that they could do, or really anything in a private company, compared to the public markets investors, like you wouldn't be allowed to get away with that in the public markets, although maybe some people are secretly getting away with it. I don't know. So I just think it's hard to win in the world of VC, but I think it's good. You're supporting entrepreneurs and companies, and maybe it's deeper than just getting an extra 200 or 300 basis points return. Now, again, I don't want to make it a VC discussion. It's mostly focused on the PE side, but they kind of crossed over just a little bit. Two areas where I would like to bring Rob in, and I'm going to actually state one that's going to sound like I'm making Rob's case for him, but then I'm going to see if I could tear it apart a little bit. I believe I heard on a well-known podcast, a wonderful guest who I do know, I don't think he maybe doesn't want me to mention his name, but he quoted Hamilton Lane, who's a very prominent organization that does research and studies. They showed that private equity 20-year window, not the last 2 years though, wink, wink, but 2002 to 2022, net of fees showed 14.8, compared to, let's go with a benchmark. That's another discussion we could have on what's a proper benchmark, I believe was 9.8. Now, again, they're leaving out the last 2 years that, broadly speaking, and depending on the start and the end date, would not have been as favorable. I'm still going to argue I effectively have, quote unquote, no control, liquidity to a degree, and transparency to a degree, like I mentioned in the S&P or the NASDAQ or the Triple Q. But I think here's one that people don't talk about, and it's probably going to make the industry hate me that I'm kind of bringing it up. There is some level of one, and Warren Buffett spoke about this, relative to mark to market. I don't really know. Not to say that shenanigans don't go on in public companies. They do. They go on more, obviously, in less under the radar, quote unquote, in private companies and in funds that want to make their fund look good so they could do the next raise. I'm also going to bring up, how about survivorship bias? So you're not factoring in the ones that went under. And I know this is true with hedge funds. I'm going to assume it's true in some of the research and studies with private equity, is that how about those that don't report because they're not really that good? So is it going to favor survivorship bias, and arguably those that dropped off or simply are not doing that good are off the grid of any sort of reporting? And again, Buffett also stated this, so I'm not the only one. And that's not to say, by the way, that I don't believe private equity is valuable and that there's some funds, probably 5 to 10%, that are worth it in various niche and sectors that may be valuable for a family to invest part of their allocation in, especially if they have access to insider info, deal flow, some of the things that Rob noted. But before we progress to the next point that we could both learn from, Rob, are you familiar with that Hamilton Lane study? And what did you think about me trying to poke some holes in it?
Only vaguely familiar with it. So I may know enough to be dangerous, maybe not even. But so no, again, but just broadly, there's a lot of logic to you have to intersect one thing. Maybe I'll say it this way: timeliness is also important, because you were talking about a time frame of X to Y, 20 years, and then a couple of years maybe not so good. That's the other thing too, is electing when to get into certain market sectors, electing when to lighten up on them, having that ability to be nimble. And sometimes, look, no one ever went broke taking a profit. And I remember one of Warren Buffett's, famous quotes was when he was asked, how did you become so successful in all of these different swim lanes? And I recall the answer, him saying, well, I always sold too soon. And so, again, nothing wrong with that. And when at a fund level, at a private equity level, even as I would say, we're a little bit of a VC woven into it, we have that ability to do some rebalance and be nimble and take advantage of market situations and play them. So again, it's not it. I want to view us as an organic type of thing, and that is more of a challenge in a single company investment. If you're hit, let's say your company is involved in live entertainment and a pandemic comes along, it's over. And I know companies that it was over for, and they had terrific management and terrific people. And so back to that thing where the diversity is risk mitigation. And if you're with people that are nimble, I think then you can take advantage of, accelerate here and flatten out over there.
And the other topic that I'll bring that we could mutually learn and have a valuable discussion. But before I say that, again, it appears to be, which is true, that I am an advocate and a believer that he or she who holds the keys to the kingdom, that is key. I want it to be me. I didn't even bring up counterparty risk, which is not quite as applicable in private equity as some other GP/LP structures, but theoretically still in play. There's a service that I am working with someone on for some of my single family offices that this guy is probably the best ever in understanding counterparty risk. Shockingly, how many funds, maybe it's just simply an oversight and a mistake, the returns, the MOOC, the IRR that they're reporting is not perfectly accurate. And I'm always afraid of the next Madoff or other thing that is out there. Again, more applicable to hedge funds relative to certain counterparty risk and leverage. When it's my stuff, my company, and I'm also checking for fraud in my own single family office too. I got my nose to the grindstone and I'm really on it. Now, some of you are going to state, man, I'm at a liquidity stage where I don't want to do that. I get it. Then don't do that. But then don't come to me that if you have children and they're not engaged by your legacy, by knowing how the world works, interest rates, economics, etc., and they don't know what they don't know, then you took the easy road. Being a parent, being a grandparent, continuing your legacy and your continuity is constant work. It's hard. And maybe some of you just aren't up to it. Now, boy, that made me really popular with the audience, Rob. I'm digging my own grave the more that I keep on going in. But the subject that I think that whether a direct investor or a PE investor that we could all kind of agree with and are interested in as we take it a little bit to the home stretch is among the most common questions I get is sourcing deal flow. Uh-huh. So I look at it as my network built up over 20 years, including fund sponsors, other families, other industry people, other peers, and even SFO groups, industry events in the construction, like I said earlier, with fencing or other industries that they have national and regional events that I go to. When I was really actively looking at RV parks, I belonged to the New England RV Park Association, and that gave me access to potentially reach out to people. So maybe, and of course, there's databases, Hoovers, and there's newer services relative to using those databases combined with AI that is getting very intriguing to the ability to source companies. I could argue that's good and bad. The good news is I have more opportunity and information at my fingertips and more targeted than ever before. What's the bad, Rob? Damn it, so does everyone else. So what are you guys doing, and what advice would you have on the sourcing side?
No, that's great because that if we have a superpower in our fund, it is access to deal flow, and it comes from it's not a magical power. It comes from, again, you're probably sick of me saying the network effect, but we're not in our second year out of MBA school. The leadership here has been involved in a number of things, have been successful over time, and at the end of the day, people want to do business with people they trust. Life's too short otherwise. You've seen a million examples of that. And so we have developed through time and through actual deliverables, a very robust ecosystem. And so I'm sure others can say the same, but in our instance, it's working, and it's translated into being invited into something like HyperIce, invited into something like FanDuel or Lemonade, where, in the FanDuel example, it was KKR and Google Ventures and Shamrock, the Disney family office. And again, same terms and conditions, just smaller participant. And on and on and on. If you do it once or twice, maybe you knew someone's brother-in-law, or you were fortunate. But in our particular case, there are literally a dozen examples of that, where those strategic investors, those co-investors with us, not only contribute their expertise, but they would also, we are able to deploy our limited partner network. I'll give you, if I can go by one example.
Sure.
Company called Luna. It's home physical therapy. Co-investors were AARP and GE Ventures. Not surprisingly, AARP designated Luna as a sole provider of home PT for their 38 million members. Okay, so there's the value of a strategic investor. Additionally, within our LP group, there's a couple of guys that have a very successful intellectual property, intellectual property finance practice. And so they were able to organize an IP finance transaction for Luna at the turn of this past year, for non-dilutive growth capital. So we're leveraging ourselves with the access to deal flow, two, the partnership arrangements that we have, the co-investment arrangements, and we got a lot of strong guys pulling on the sled.
Understood. So, other things that we'll probably leave on the table, but just so families and family offices could think about, there also is the opportunity in terms of looking at a current small private equity fund, but you really believe in them, and maybe they're really only going to raise, 30, 40, 50 million, depending on the size of your family office and a variety of other factors. You may want to, maybe you buy them and bring that in-house, but you give them a piece of the action relative so they have motivation on the back end. Maybe you invest in the GP interest. Maybe if it's more venture, more earlier stage, a little bit similar, you form a VC studio. These are all things that I've worked with families on. There's more than one way to skin a cat. We're being a little bit bifurcated in a debate today where me being hardcore on direct controlling interest, and Rob, although a little more diverse than me, being focused on being an LP investor. For certain people, we're both right perfectly as we're talking about, me on my side and him on his. For most, It's more complicated. It's gray. It's easier to be an LP, and maybe that is the right choice, but there is a lure, I'll admit, to being a direct investor, to potentially having some level of control, especially if you have a level of successes in what you do, connections to make a business better, and just feel that you can make a really drastic impact. So on that note, Rob, before I give my final close, I'll give the floor to you, including for those that would like to learn more about your fund, how they could learn more about you, the organization, and I guess an email, how they could reach out to you.
Oh, sure. Yeah, that's fine. I would be happy to visit on specifics about our fund. I don't know how my email address is rgrenley@vpeg.net. I don't know if that can be shared with people.
Spell your last name, Rob.
Grenley.
And say the email one more time.
At vpeg.net. Stands for Visionary Private Equity Group. That's the name of our fund.
And could people learn more? Is there a website? Could they follow you on LinkedIn? Any of that?
Of course. Yeah, absolutely. The website. That's my email address. If people have any inquiries, there's, we're at a stage in our fund where it's pretty exciting. Again, as I said, late stage. We have a track record, and everyone, I guess, likes to be last guys in a deal because they can certainly grade our homework, and you're closer to liquidity. And we're at an inflection point with several of our largest holdings. That's not for today, but that's certainly something I love to talk about because one of them is in clean energy. We also were very much impact driven as well. If you saw the back of our business cards, as archaic as a business card is, it says purpose driven private equity. So we believe you can do well and do good. And that's part of that inclusive thing, Angelo. And that's another reason why we've had the access to the deal flow we've had. And therefore, the elevated mark to market that we have, it's a 2x compared to the buy-in price. So, again, if people are interested, I would love to engage them and have a conversation. Sure.
And Rob, did you want to give a commentary, 30 seconds or not, relative to a little bit of the debate between being very direct from my perspective, often controlling, versus being the LP?
Sure. Again, I'm not a zero-sum game person, and that's why some of the risk in being a direct investor depends on the stage. If it's an established enterprise, okay, not relevant. But if it is something that is a relatively young enterprise, there is that there's a long road to go, and a lot of businesses are not successful. It's a fact, and that can be individually, a 1 or a 0. In a fund, there's mitigation of that by virtue of diversity, and if it's a mature fund, you can see the value that's already been created. So I'm in the building of a portfolio for our audience. I think there's elements to consider for both.
Excellent. And for those that are live, today I have an other live that I will open up a little bit more, at least on LinkedIn, at 4 p.m. Eastern. Manish, who used to work at Bridgewater, he's a very smart guy, and he's going to state, and boy, it's different than you, Rob, basically are 15 stocks, public equities, all you need. Now, there's lots of what he says I agree with, but there is going to be some I disagree with, and I look forward to that discussion. In terms of putting a little bit of a bow on today, I really appreciate Rob coming on. You'll be surprised how many people are uncomfortable and don't want to come on to anything that even is a little bit like a debate. I probably had about 10 people in the last 30 days that agreed to come on. I felt it would have been worked better as a debate, and they just feel a little uncomfortable with what I would call slightly confrontational, or where it may get a little disagreement. And again, I think how we learn. I learned today. I hope many of you did as well. And on a variety of topics, more specifically in the family office world, if you have ideas of people that would like to come on, that may be an interesting counterpart to some of my thoughts on geopolitics, economics, or investing, and how it all comes back to family offices. Bring it on, I might add. And in terms of concluding, and actually, Rob did remind me, in my case, you may be different. In my case of looking at direct investments with controlling interest, I absolutely am buying into profitable companies. I am not a turnaround specialist. It's intriguing. Maybe I could bring in an operator who does have more experiences with that. I'm open to it. And that's also a key difference between earlier stage and VC. I'm buying hope. I'm buying promise. It's cool supporting entrepreneurs. Maybe I get 1,000 to 1. I'm not going to get that in some of the blue collar stuff that I'm investing in. And we didn't have time today to get in. What do I look at in initial diligence, negotiation, pricing? What's more valuable, price or terms? To me, control the terms. You control everything. How to do deeper diligence. Do business owners lie to you and sometimes fabricate financials and other things? Yes, I know. Trust me. So this is not for the weak or the meek.
Yeah.
And that being said, again, I feel a level of safety that I'm buying into profits. We didn't have time to get into what's happening with the former owner. Is there an earnout? Non-competes. What if one salesperson drives the business and he won't sign a non-compete? Suppose they're not applicable in today's world via the FTC ruling. So there's a lot of devil in the details, which is probably driving more people to say, damn it sounds too hard. Let me just be an LP. But I ask you, I beg of you to at least consider. If I could do it, anyone could do it. And again, I think the industry makes it harder than it needs to be. And I'm not saying Rob, those Wall Street and with conflicted interest often try to talk you out of it because, again, it's not to their advantage that you want to do it. How do people get paid? If you go to that tends to answer very simply a lot of the questions. On that note, everyone, I'm Angelo Robles. I hope you subscribe to @FamilyOffice on YouTube. Why not @FamilyOffice TV as well? If you're more of a car listener, Apple and Spotify, a traditional podcast, I am active on LinkedIn. And join SFO Continuity. We do 100+ proprietary digital programs that are deep dives. I do well over 30 in-person programs from greater New York City to Palm Beach, Jackson Hole, and a little bit of LA. I've been active around the world. I've been in the community a long time. I have a truckload of proprietary best practices and content that I share with my members, and resources and connecting the dots where we could all mutually be of value to each other. As I wrap up, one of my members, listen to this, one of my members over the years, including to a degree through his GP interest, has invested in over 900 private companies. You heard that right. Wow. He's a member. You don't think you're going to learn anything from him? He's incredible. The lessons learned, the opportunities, the network, and honestly, rather bluntly, you get that from joining my private club that is dedicated to real investors and single family offices only. Some consideration to a founding partner who's an active allocator in an MFO. I'm looking to find the right one, haven't really quite found it yet. So go to angelorobles.com and simply learn more. I thank you all for your time today. Rob, you were a very special guest. I appreciate it. I look forward to meeting you in person soon. Everyone have a great day. And those that are live, in about one more hour, I may see some of you again. Double duty for me today. Thank you and have a great day.
Thanks, Angelo. Pleasure to be on.